All right. Welcome everybody out there in YouTube land. This is Rain on the Charts again with another in our Trading Basics series. And today we're going to be talking about lot size and leverage as it relates to Forex trading. And I thought it would be good to have this as the topic since last week we covered spreads and margins. So I'm going to hopefully get some participation from you guys here. Um, and this is something that I really didn't, you trade, but you don't really know all the specifics of it, but you're just doing it. But it's good to learn why we do what we do, right? So we covered that the spread is the money that the brokers charge us every time we're taking the trade, right? So what's leverage? You know, you hear about leverage, the margin trading, but what is it? Does anybody have any idea what it is? Hi, Laverne, how are you doing? Hi, Michael. Michael is tuning in from Nigeria. Welcome. That's commitment right there, as it is 10 o'clock at night, right? Does anybody know what it is? Leverage as it relates to trading, how it can work for us? Okay.
Because you're using other people's money? Well, a broker's money?
Exactly. So leverage is what's going to give us that buying power that we otherwise would not have had, right? So when it comes to leverage, it can work for you, but it can work against you if you're not careful. It's like a double-edged sword. And if you don't understand it, that's how you can blow your account and not really understand how did this happen. Because remember, you can start trading and just have $10, $20, $100, but you're able to multiply that money. It's because you're able to borrow from the broker. So when you're creating an account, and you know what? I think I'll do the same thing I did last week. I will go to, let me join the Zoom from my phone, and I'll set up an account, and we're going to see where it asks you about leverage. And most people are just going to see it and they're going to choose the highest thing, not really understanding what that potentially means. Does everybody on here have a demo account or a live account? Say co-host. Got it. All right. Okay, good. Yes, and you should always have your demo account. Even once you start doing live trading, you still want to have your demo account, because as you're learning new things, you want to practice. You don't want to just jump into it, and have your real account be the experiment. That was not going to be cool. All right. So, all right. So you want to create a demo account, new account, right? Open a demo, and let's do Hugo's way. You search whatever broker you're going to have as your real account. You want to get the demo account that goes with that, because it's going to show you exactly what things would be like if it was your real account. So there we go. Your name is there, your phone number, your email address. And then you see it says leverage 1 to 500. No. My recommendation, guys, is say 1 to 100. 1 to 100 leverage. So for every dollar, it's giving you like $100 in buying power. So if you have $100, what's 100 times 100? 10,000, right? Yes, no, 10,000? It's giving you $10,000 in buying power. So it's like you're now borrowing. The broker is giving you $10,000 in buying power, even though you have only $100. So if you were to stick with what they just give you automatically, 500 in leverage, you multiply the 100 times the 500, right? The $100 that you open the account with, you times it by whatever that number is in the leverage. So that would be $50,000, right? In buying power. So that's how leverage works. You get to borrow from the broker. Now, let's take a step back and talk about the different types of lot sizes. So I'm going to share my whiteboard here. That's loading. All right. You guys should be able to see the whiteboard, correct?
Yes.
Okay, thank you. All right. So lot size. I'm going to talk about 3 different types of lot size. One is the standard lot. The standard lot size is 1, right? That's a standard lot. 1. Now, if you have $100 in your account, there's no way you should be doing a 1, a standard lot size. A standard lot size is for accounts of $100,000 or more, right? Most people don't have $100,000. But that's why leverage is good, because it will give you that buying power depending on how much you start with. So if you have $1,000 and you do a 1 to 100 leverage, that can give you 10,000. If you have $10,000 and you do a 1 to 100 leverage, that will give you $100,000. I have the math right? You just add the zeros to the end of the number. That's what I remember from school. Just add the zeros to the number, right? So a standard lot is 1. Next, we have a mini lot. The mini lot is 0.10, right? And with that, you have like 10,000 units for a mini lot. And then the micro lot is 0.01. That's the micro lot. And that's 1,000 units. So if you want to be using a lot size of 1, you need to have $100,000. If you want to be using a lot size of 0.10, you need to have $10,000. And the micro lot 0.01 is if you have $1,000. Now, most people don't have $100,000, $10,000, or even $1,000. You know, you hear people saying, hey, you can start trading. You just, if you even have $10, some brokers will let you trade starting out with $10 because of leverage. But remember, I said it's a double-edged sword. So when you have the lot size of one pip, one pip is going to be equal to $10. So, oh, I put the wrong thing. One pip equals $10. So every time your account goes in one pip in profit, that's another $10 that you're making when you have a standard lot. Nice, right? Now, with a mini lot, one pip is going to be equal to $1. And with a micro lot, one pip is actually 10 cents. So would you rather make $10 per pip, $1 per pip, or 10 cents per pip is the question. Most people want to make more than 10 cents per pip. But that's where patience needs to come in. You want to be patient. You don't want to be in too much of a rush when you're new, as you're learning, because the same way one pip equals $10 means if it's minus one pip, you're losing $10. And where they lend you $100,000, depending on what leverage you chose, when it comes to your account going in the minus, they're not gonna allow you to lose $100,000. They're gonna go based on however much money you actually have in your account. Do you guys understand that?
Yes.
Okay, great. So let's say some popular leverage we saw 1 to 500. 1 to 100 is what I recommend, right? 1, my daughter, sorry. Just pick it up. All right, trying to erase. Okay, there we go. All right. 1 to 50, right? So when you look at the leverage, and then you want to say, okay, how does one thing affect the other, right? So say you have $100. Can I just draw? I'm just gonna draw. Say you have $100. Right? Or let's say $1,000. So you have $1,000, and you see how when I opened that, when I went to open up that demo account, it had the 1 to 500 leverage. So to know what your buying power is, you're going to times whatever the amount of money it is that you're opening up with. In this instance, it's going to be $1,000. We're going to times it by the leverage. So one, it's going to be 500. So we're just going to add these two zeros. So that's the buying power, right? So, and then we're going to times it by 5. So we actually have 500,000 in buying power, right? 5. Ooh, I'm doing this from my pad, my mouse, my pad. I don't have a mouse. Pardon me. I feel like I'm in kindergarten. Right? So you have 500,000. So that means 1 pip is going to be $50, right? Are you guys understand why 1 pip is $50? Yes, no. If
Yeah.
okay, thank you. Because if $100,000, 1 pip is $10. If it's $500,000, 1 pip is going to be $50, right? So how leverage can work for you is that, hey, if you're making profits, if you do 10 pips, $50 times 10, that's $500 just like that for just 10 pips, right? But if you are losing, remember, you only actually have $1,000 in your account. If you go 20 pips negative, that's $1,000 that you've lost and you've blown your account. Make sense? So it can work against you because 20 pips is not a lot. 20 pips is not a lot at all. So you need to be able to go lower than that. Like GJ, which is my favorite pair to trade, my stop loss is 50 pips. So based on what I'm telling you, if I go 10 pips in profit, I'm making $500. Great. But if it draws down first, oftentimes it pulls back before it actually goes in profit. It couldn't even handle a little bit of drawdown before I'm out of the trade. So that's why you don't want to mess with 500 leverage when you're starting out. You want to start low. And then when you get more experienced, if you do want to go ahead and open up an account with a higher leverage, that's going to give you more buying power, go for it. But do not start out with that high leverage because it can definitely mess you up. I hope that explains it for you. Debbie, I hope that gave you some clarity based on the conversation we had the other day. Does anybody have any questions? And I see you, Barry. Welcome. No questions?
No.
Okay. Wow. everybody got that. All right. Okay. So that is that for that. So let me actually go to the charts. All right. All right, let's take a quick look at trading view today. All right, gold. Remove this alert. All right. All right. So let us take a look at a little bit of price action. We look at GJ. So you guys know that a green candle represents a buy or bullish movement going long in the market. A red candle represents the sell going short in the market. going down, right? So I personally like to trade with the trend. So I will look for something that's trending. And I know that with the different markets, there are different times when the volatility is higher. So like GBP, JPY, I like to trade that around 4 a.m. Eastern Standard Time. That's going to be around 9 o'clock for you, Michael, over there in Nigeria, around 9 o'clock in the morning, 4 o'clock for me. That is when GBP pairs are moving. So you can get some volatility. You can see a trend, a clear trend, and you can capitalize off of that. So for me, when a market is trending in the upward direction, I like to buy the ceiling of an uptrend. So definitely, I know that if you go on YouTube and you look up how to trade, you will hear buy the ceiling, sell the floor. No, buy the floor, sell the ceiling. Sorry. But that's not always the case. That is if the market is in consolidation, right? Consolidation means that you can have price moving between two lines. And we see consolidation right here. It's right here. So that's the floor. That's the ceiling. And the price is not breaking up above or below. It's just playing around inside two lines, right? So this is the floor or support. Let's write that. Support, right? That's support. And here's resistance, right? So this is not a trending market. Trending market is like this, where it's just going, it's decided that it's making a move up. That is a trending market. That's an uptrend. But we know that it typically doesn't just go in a straight line. It's going to, you know, go, this is how this one decided to move. Hold on. This is in the way. Okay. Okay. It doesn't just go straight, right? There. Up, down, up, down, up. So, right, it's not just a straight line. So this is an uptrend. Right here, we have the consolidation. Up, down, up, down. Now, there are people who will trade this. So they're going to buy the floor or support, and they will sell the ceiling or resistance. Me personally, I wait for the breakout. I need to see price either break above, which it looks, we can see something happening here, right? Break above, close, a pullback, and then I continue to the upside, right? But that's something that I have to watch for, right? Once it closes above this area here, I'm going to be looking for a retest and then to take it up. Now, so that's one possibility, but another possibility is for price to break below. It can also break below, close below, retest, and then continue down. So when it comes to trading, never think that you know what's happening. Anything can happen. It doesn't matter if you believe that you're the most perfect technical analyst and you say, oh yeah, this is what's going to happen. Anything can happen at any given moment. And then you're going to be like, oh, so that's why you want to exercise proper risk, because you wouldn't want to enter a trade feeling 100% about it. Say, oh, I'm going to risk, oh, I have $1,000 in my account. Let me risk the whole $1,000 because I am sure. That could be the time when you lose the entire thing, right? You want to always exercise proper risk and just wait on things to play out. Allow it to happen and then you just follow along. So you wait for it to either break above or break below, and then you use proper risk. And risk is 1% if you are, a conservative trader, 2% if you're moderate, you can handle a little bit of risk, 3% if you're an aggressive trader. I don't suggest risking more than 3%. And actually, career traders, a lot of them, like the ones who are heavily into it, they don't even risk 1% of their account. They risk 0.5%. But I guess if somebody has millions of dollars, risking 0.5% is gonna look a little bit different than if you have $200. So that's why they can do that, and it's like no big deal. Does anybody have any questions? No questions? Does anybody have any questions about anything else then that they've been studying and they need a little bit of tweaking?
Can you go over when you enter the trade again?
Okay. All right. All right. So when I'm going to enter a trade, hold on. I'm waiting on the price to, okay, so there are 20 seconds left in this candle. So I need to see price close above, which it did. I was waiting on a pullback. It did pull back, but then it already started to go up. So I would take this trade for a buy right now where it is actually, because it broke above the resistance line. So remember I said I would want it to close above the line, and it did so with this candle. It closed above, right? So it's all about waiting. You're waiting, you're waiting. Did it close above here? No, it kissed it, and then, well, it didn't even kiss it. It came pretty close, but then it closed here, went down. It came here, but it didn't close, it went down. You just have to wait patiently for price to actually close above or below. It's whatever the market decides it wants to do. You're just gonna wait. Once it closes above, you wait for the pullback. Now, it did pull back. We saw the candle was red at one point, but it didn't close down. It went back up, and see now the next candle is green. So I would take this trade. I would have taken this trade when this candle closed, right? So let me go to an empty space here. All right, so to illustrate. So we know that price is going up, and we know that how we identify an uptrend is that we have higher highs and higher lows, right? That's how we identify it. This was resistance. It became support here. And that's what you're looking for resistance to become support. Now, when you're looking to enter a trade, since we know that price doesn't just go up smoothly, you want to wait on the pullback before you get into the trade, right? So here's the pullback. This would be a place to enter. Goes up. This is not the place to enter. You wait for the pullback. So this is an entry point. You enter here. Enter here. Right? Can enter here. Right? Not here. We're not entering at the top here. We're not entering at the top here. Oh, she was gone?
No, I'm here. I'm just going from my phone to my computer.
Oh, okay.
Thank you.
No problem.
Watching.
Okay. All right. So yeah, you don't want to enter here because depending on your stop loss, right? So me personally, all right, let me just go ahead and put the stop loss. So my stop loss, I would have my stop loss, say right here. Let's make this red. This is my stop loss, right? So I wouldn't want to enter a trade and then it comes down and hit my stop loss. Some people may enter here, they have their stop loss here. It could come all the way down here because this was the other level. This was the other zone. They getting up here, they think, oh, my stop loss can be here. No, my stop loss would be down here. You know, if somebody sees price here, I mean, somebody missed the entry down here. They see it here and it has great momentum. They're like, oh, let me get in. But you get in and then price pulls back. It could pull back down here, not here, you know? And you notice I put my my stop loss a little bit below this. Actually, if I put it a little bit lower. So that's what you want to do. You want to bring it, you want to put your stop loss down here. You don't want to enter up here. You want to enter at the pullback. So once it pulls back, maybe not that first candle, maybe the next candle, you know, you just want to make sure. And then you enter the trade. And this can be your take profit. Unless you're someone who like, oh, I want to see if I can get 999 pips. But for me, I see that when I enter a trade, if it's GJ, I'm gonna go for 50 pips. If it's something else, I'm just gonna go for 20 pips. 20 pips seems to be a really solid endeavor, you know, something that you can actually accomplish. So imagine if you can get 20 pips a day, for 5 days, if you're someone who trades 5 days, the best days to trade are Tuesday, Wednesday, Thursday, from what I've seen. Right? Tuesday, Wednesday, Thursday, you trade, get minimum 20 pips. If you're someone who knows how to trail your stop loss, turn your stop loss into stop profit. If you don't know how, go and watch one of my videos that goes over that, because I have a video going over that. To find it, you can go to my playlist and you'll be able to search the titles there to find it. So once you hit this, which I would say that is a take profit, right? You can enter here and this can be your take profit. Once you get here, you can move your stop loss up, right? Above your entry. And now you're in a risk-free trade. If you didn't want to make this your take profit, you take partials, and as your trade goes further and further into profit, you can just keep moving your stop loss up. Is that good?
Yes, that helped a lot. That's because I went back to try to go back and watch your videos and I could not find it. So I just need to type in Rain on the Charts in your playlist.
Okay, yes, because I have my playlist Trading Basics, but
Okay.
I also have other playlists that have whatever. If I have multiple videos on a topic, I'll
Okay.
just create a playlist with that topic. So if
Okay.
you go under the playlist tab, you can find
Okay.
yeah.
Okay. But that helped a lot. That really clarified a lot for me. Thank you so much.
Okay, awesome. Glad I was able to help. All right, so I think I covered what I wanted to cover for today, actually. Oh, and my daughter just brought me a cookie. Guys, my daughter is a little baker. Yeah. All right. But yes, that's going to be it. Since nobody else has any questions. Thank you everybody for coming. Everybody that is here, I hope you're subscribed to my YouTube channel, Rain on the Charts. Everybody out there in YouTube land, please go ahead and subscribe if you're not already subscribed. Like, comment, share my videos. And I'm actually going to be curating a series of videos, which will be like A to Z of trading. So for anybody who, you know, wants to take it step by step, I'm going to be working on that for the month of May, because I know right now I'm just coming on doing videos, but it's not in a sequence, but I'm going to have videos in sequence, and it's not going to be an hour long. Each video is going to be maybe 15 minutes, just getting to the point, you know? But yeah, that's what I'm going to be doing. Thank you. You think that's a good idea, Susan? Awesome. Thanks. All right. Yes. Okay. Well, and let me say bye to you guys out there in YouTube land. And I will see you next week for our next video. I don't know what it will be about yet, but stay tuned. Bye-bye.
Bye.
All right,
Thank you.
guys.
Bye-bye.